I love doing the first panel of the morning because it means we have the best attendance from the audience. As I look around, I hope to see all of you the same way at the last panel of the day, but something tells me it'll be a different number of people. For those that don't know me, my name is Josh Jacobs. I recently joined US Bank as the Chief Commercial Officer for their ETF business. And I have an esteemed panel next to me, and I'll allow you each to do the honors of introducing yourselves. So, Andrew, you want to kick it off?
Hello, I'm Andrew Channon. I am the CEO and co-founder of ProcureAM. We're a thematic ETF provider. Our parent company also specializes in some other things, including consulting and IP. And two of our funds that we're excited about right now is our space ETF UFO and our natural disaster focused fund FIXT, which ties into some of the keynotes climate change ideas that he was touching on earlier.
Hi everyone, I'm Allie Doyle. I lead ETF listings at NASDAQ.
Hi, I'm Chris Hempstead. I'm with Murray Asset Securities. We are the broker-dealer arm of Murray Asset Global. They own Global X and now Global X Canada and another Tiger issuer over in Asia. On the brokerage division here in America, we work as an authorized participant, do market making and seeding of ETFs. Globally, we are a UCITS market maker in the European region, and we're a market maker in ETFs in Hong Kong and Seoul, Korea, and expanding into India as well.
Thanks, Chris. So as you see, we have a diverse group of people on the panel with different experiences and backgrounds and different roles in the infrastructure. And so we're here today to really dig into the infrastructure and what that means and how does it allow an ETF to operate in the manner that everyone else sees in the retail environment. So Chris, I'll start off with you, but can you give an overview of what is a market maker, what do they do, and what are the expectations from an advisor as a market maker when new products come to list?
Okay, so the easy definition, and many people in the room, I know a lot of my friends and colleagues in the room I've known for a long time know this, but for those of you that may be hearing it for the first or second or third time, and it does take a while to really get into your blood if you don't do it every day. But market making is really the process by which a market participant will provide liquidity in the absence of any other natural liquidity. So if, as an individual investor, if I were to trade with Allie, I was a buyer and she was a seller, and we went to the New York Stock Exchange or NASDAQ. We would definitely go to NASDAQ. Whoops.
Okay.
Gosh, all of a sudden I wish I had a...
Chris, I shouldn't have to say this. Behave.
So we would what we would call pair off, right? Because the NASDAQ would allow us to meet together in the marketplace and achieve really the most efficient execution, buyer to seller. Market makers step in when there's an absence of one side of that market. Market makers rarely, I should say rarely, but market makers generally wouldn't be trading with one another. They're generally there to capture arbitrage, and then more importantly, to provide what we would used to call on the exchange a fair and orderly market in a security. Now for ETFs, it's really kind of a science. With a stock, it's very hard for a market maker to know exactly what it's worth, right? But for an ETF, because we know the components, we do know what it's worth. So of the 3,500 or so ETFs that are listed in the US, all but maybe 1,000 of them don't trade a whole lot. Right? They just don't have a lot of daily activity. So most of the volume in those 2,500 or so ETFs happen because a market maker is present providing liquidity on one side or another of the market. Market makers aren't really needed as much in the top 1,000 except for extreme circumstances where there's vacuums in liquidity or block demand and things along those lines. A lot of times in those most popular products, SPY or QQQ or something like that, investors are trading with one another all the time, really disintermediating the market makers. And so there's two styles of market maker. There's the really, really busy market makers, and you probably know the names of those firms that trade billions and billions of dollars a day. And then there's market makers that act more like an old school specialist, just to sit there, provide a fair and orderly market, put up a bid, put up an offer, so that if you're an issuer or a wholesaler and you're talking to one of your clients, and they pull it up on their screen, they see an actionable quote where they'll be able to buy or sell at a fair price.
No more competitors you want to mention for people on the panel?
Sibo.
Okay. So now I'm going to hand it over to Allie at the NASDAQ exchange to give her overview of it. But Allie, could you just give an update from the exchange perspective? How does you interact with a market maker? And obviously on the flip side from Chris, how does it impact your day-to-day?
Yeah, great. So obviously, exchange-traded funds, exchange is right in the name. We see ourselves, our team, and the resources we provide as a really key focal point to the issuer experience. The interactions that my team has with Chris are certainly really valuable, but we see that as a lot of the value that we can bring to the issuer experience, the asset managers that are launching ETFs. And our day-to-day is really consists of speaking with existing clients, many of which are in this room, but also especially recently, new firms from, RIAs that maybe have been ETF allocators up to, the largest global asset managers that are just now considering and thinking about bringing ETFs into their lineup. So again, we see ourselves as a really key focal central point of the ETF ecosystem in making those introductions to market makers for new issuers that maybe don't have those relationships is definitely a lot of the value that we can provide. Especially, in some of those pre-launch conversations. I think we're going to get into some best practices later, but one that we always mention to issuers is, starting to have some of those market maker conversations kind of as early in the process as you can, just to get a sense of who would be best suited to take on your product as, a lead market maker or what we call a designated liquidity provider, and just really getting a sense of what that relationship looks like between issuers and, market makers. So again, aside from that, which we can get into some of those details on, how we provide liquidity in the market in some of our programs. Again, just some of the other resources we provide are around regulatory support, product development ideas, and then a lot around co-marketing and helping issuers think about how they can help distribute their products in the market. As Chris said, it's 3,500 ETFs now. It's definitely, I wouldn't call it a crowded space, but it's busy, right? There's a lot of products out there, and so there's a lot of resources that the exchange can provide in terms of both our own organic brand and partnerships we've developed in helping, again, especially new issuers kind of navigate how they get their products in front of the right people.
And keep in mind, if Andrew, who's about to tell you about what he does, but if he brings a product to market and out of the gate it starts trading, 500,000, 1 million, 5 million, 10 million shares a day, Allie and I really don't have a place in there as a lead market maker or introductions. There's no need for it because once his product has reached that sort of core maturity, and sometimes it happens very fast, there'll be 15, 20 or more market makers in the box all day, every day, without even asking permission. They'll just register and they'll make markets in it because there's activity there. So there's no real need for a surrogate market maker like me to step in and post a fair and orderly market because it happens naturally.
Excellent. Andrew, so now in your role as an issuer and an advisor, exchanges and market makers are service providers, and you have to provide oversight on them. Can you give a little overview from your perspective on how you interact with both parties?
Certainly. So, one of the early stages before launching an ETF is lining up all the service providers. So certainly you have to do various levels of due diligence, whether that's interviewing potential service providers, talking to existing clients of theirs, doing whatever research you could figure out to make sure you're finding the ideal fit. Some of those things might come down to pricing, services that they provide, areas of expertise. Maybe it's even just the people that you already know, you like, and you want to work with them. For working with a liquidity provider, your lead market maker, your DLP, when you're doing that, one of the things that many independent or startup issuers might be interested in is seeing if they're willing to provide any seed capital. As you launch a new fund, you need to have some assets in it before you actually start that process. And sometimes your lead market maker may be willing to step in and provide that initial seed capital. Sometimes around 2 million or so. Sometimes if you get really lucky, it could be a lot more. In the early days when I started off my career in the ETF industry in 2007, you would actually have lead market makers and specialists competing, trying to outbid each other for who could actually provide more in seed capital. Unfortunately, those days are long gone unless you have some just extremely interesting and differentiated product. But now having relationships is really helpful on that front. The other part, to that point of people on the stage that you want to talk to are exchanges, and I've had relationships with exchanges both as a clerk on the floor, as a lead market maker, as a liquidity provider, as a designated market maker, as a registered market maker, as well as an issuer. And There's only so many ETF exchanges that you can actually go and talk to here in the U.S. I've actually had the fortune of working with NASDAQ for many years now, from many different forms of relationship, including entities that they've acquired over the years, like the International Securities Exchange, which I started working with back in 2011, all the way to them being the exchange for many of the funds that I've brought to market over the years. And like Ali had mentioned, it's not just an exchange that you're getting. It's, you need to trust that, they understand what you're doing and support you, that they can answer your questions if you need them. If there's some issue that happens before the open, do you have the right people that you could contact to make sure that if there's any compliance or other types of issues that need to be reported, that they're there and able to help walk through that process with you? But certainly, are there other things that they could also provide? Sometimes that's bell ringings, that's interviews, there's other types of co-marketing pieces that Ali hit on, that sometimes it's just getting your strategy in order and saying, hey, is this a completely crazy idea, or should I go ahead and try it? And working with your service providers, lots of times you're getting more than just those services that you're paying for. It's also the relationships, their experience, and the people on their team that you end up becoming very close with and can help guide you in the right direction in many cases.
No, makes sense. And I think what you'll hear from this panel of people from different parties is that, stop making me laugh, is that it's very much a symbiotic relationship. We all have to work together in order to ensure that our clients, not just new entrants, but also when existing issuers are launching new product that they may have not have an expertise in before, a new region or new asset class. We all have to work together to ensure that we are partnering and making sure there's a smooth launch across the board. Now, one thing you did say to Andrew that I'm going to have to highlight, and I'm going to speak on behalf of all service providers, price is not the most important thing. Price is a factor, don't get me wrong, but that is not what drives a successful launch. That is not what drives a successful product. And it's really the consultative nature that all of us offer to our prospective clients that allows our clients to launch products that eventually gather assets and pay the bills for everybody. Andrew, so you've talked a little bit about some of your experiences working with these parties. Can you talk through about what you can do as an issuer that can help make the market maker's job easier?
Yeah, so before you launch a product, making sure that once you've lined up your market maker, understanding that they know how to price your product, if there's any nuances, that they have everything lined up so that when you have your final launch, that everything is smooth sailing. Sometimes it's before the launch if they are doing the seed trades, to bring those initial assets in, but certainly you want to be able to provide them with all the information necessary so they can provide as tight of markets as you could have possible. So that way when people look at your fund for the first time, they don't get scared away by seeing a really large and wide spread. So making sure that if there's different news events that have occurred, that it's in front of them, that might be relevant to your fund. Sometimes you might see that a symbol was halted that's in your fund, and maybe they didn't notice that. That's something that might cause them to get picked off if they're not aware of it. And there are certain things that if you make different types of regulatory changes and filings in your documents, that they may want to be aware of, so that they do price things correctly. Because having that trust and transparency is ultimately helpful in making sure that your spreads are going to be accurate and as tight as possible.
No, I think that's a great segue into the next component, which is ultimately what makes up a spread. So Andrew's talked about that you don't want a wide spread. So Chris, could you enter into a little conversation about what it actually causes the spread to be wide, narrow, and what are the things that you look at when that's being built out?
Yeah, of course, and it's pretty easy, and sometimes it's pretty obvious, but a lot of what we're talking about up here is preparation and best practices, and so it doesn't matter what we think about ETFs and the very complex but familiar ecosystem of ETFs. It includes U.S. Bank and the fund administrators and the medallion distributors. What's that? The wholesalers, the exchange, the market makers. There's so much that goes into it, and you don't want to leave out the lawyers because they're involved as well. It's logistics, and it's about just making sure that everything works and flows properly. So when an issuer or an advisor comes with an idea for an ETF, they will oftentimes ping a few market makers to say, hey, look, we're thinking of doing this. We're in the early stages. We haven't spent a whole lot of money yet. But if we do decide to go down this road, do you see anything that could be problematic with this particular structure? So the things we're looking for as liquidity providers or market makers are what is it that we're taking risk on? The most basic and easy kind of things we think about are maybe really short U.S. Treasuries, that are almost like U.S. dollar. Probably the easiest thing you could possibly take risk on in this day and age. Or really, really liquid U.S. equities or things along those lines. That's sort of one end of the spectrum where if you brought an idea or a portfolio to a market maker, they'd say, yeah, this looks pretty tight. We could probably make this a few basis points wide and be happy with that. Everybody wants a penny wide spread. It doesn't always happen. But there are other ideas that come to market. I don't know if it's ever happened yet. I know it perks up every few years, but a physical diamond ETF, it's not done yet, right?
Yeah.
Or if you're under NDA and you can't talk about it, that's fine. But I'm not. So, but every once in a while, someone brings up the idea for like a physical diamond ETF, and as a market maker, or liquidity provider, what am I thinking about? I'm like, well, where could I possibly hedge the risk of the cost of a portfolio of diamonds? It's not an easy thing to solve for. So we are not. Just understand, the market makers and liquidity providers are not the judge and jury of your product as a good or a bad idea. That's not our job. We can have an opinion, but I can tell you, in my experience, half the products that I thought would fail succeeded, and half the products that I thought would succeed failed. It's like there's no real science to it. I'm blown away sometimes with some of the ideas that come to market that are remarkably successful. So what you should be asking us, can you support our product in the market in a way that we hope it can be supported in the market? If you want single-digit basis point spreads and deep liquidity, and you build a portfolio that in its own innocent state is extremely wide and illiquid, you're probably not going to find a market maker who can come up with a solution for you. So we will oftentimes look at the portfolio that you're suggesting or the strategy you're suggesting, try to find the pain points that would be our pain points, bring it back to you, give you an opportunity to sort of rejigger the strategy or reset your expectations on what it's going to look like in the market when you do launch. Is that fair?
Yeah, I think those feedback conversations are so valuable. To your point, you guys aren't totally gatekeepers, but at least from an exchange perspective, if you're meeting the listing rules and the initial listing standards, you're going to be able to launch it. But if you're getting certain feedback from a market maker of tweaks they need to make, or this isn't going to work for this reason, it's probably good feedback to take into account pre-launch.
Not all products work in every wrapper. Obviously we're in this room because we think the ETF is a better wrapper, and we've all made our careers in it. But not every product is fit for purpose for an ETF. Ali, so we just talked about spread. Can you talk a little bit about the role of DLP versus LMM and other acronyms that some of the audience may not be familiar with?
Yeah, so super easy question for the first one. So I don't think I'm speaking out of turn. DLP equals LMM. So if they're designated liquidity provider for what we call it at NASDAQ is going to be the same as a lead market maker on the other two ETF listings exchanges. We just like to be different at NASDAQ. So, but in terms of kind of the role that those firms are playing, like we said, we can make introductions to specific firms for new issuers, kind of depending on the asset class that they're looking to be involved in. Again, we like to think of ourselves as having a pretty good pulse on the market of maybe which market makers like a Chris or other firms that are looking to become more active in certain asset classes, which are looking to take on more names. So again, just being a little bit of an agent there for new issuers. And in terms of what our DLP program provides, like was said, it's really about providing strong liquidity and the best trading experience possible for investors on NASDAQ with ETFs that are listed on NASDAQ. As the ETF industry has continued to grow, as Chris had mentioned, not all ETFs are going to trade the same amount. But as we think about our programs, it's how can we help promote sustainable tight spreads and market quality across all types of ETFs. Again, whether you're a much more liquid ETF or something that's kind of still in the incubation phase. So we take that really into account as we think about our current programs and how we want to kind of revise them as we move forward. Really, I think with that, larger bucket in mind of the products that aren't trading as much. So we've seen a real increase in what we call, usage of secondary DLPs, where a firm can take on or bring on, a second market maker. The requirements are a little bit less, in terms of the market quality that they're providing, but again, it's another market maker that they can bring on to provide that market quality, and you're able to do that the first day that you launch on, your ETF on NASDAQ. I think we take a lot of pride in the relationships that we have with market makers. We have a senior product manager on our team, Danielle Rutsky. She really kind of supports all of our market maker relationships. So as we put our programs together, we really take a lot of market maker feedback into account. We don't want to make assumptions on what is realistic or feasible or kind of what is the right route to take. So we spend a lot of time, again, not just with the issuer community, with market makers like Chris and others, to really get a sense of kind of what's feasible. So as we put our programs together, we spoke with both market makers as well as feedback that we've gotten from like private wealth platforms, for example. How do they think about approving new ETFs? What are some of the requirements that they look at? So again, we want to be aligned with the market and making sure that we are providing kind of the right appropriate support for different types of ETFs.
No, that's great. Thanks. Andrew, back to you. So when we spoke a little bit earlier on the panel, you talked about what are the things you can do working with the exchanges and the market makers pre-launch. Once you've launched that product, it's live, how do you interact with them, and what are some of the best practices that you see as an issuer?
Yeah, no, certainly open lines of communication are very important. Strategizing and making sure that people are aware of changes that you're making. Obviously, you're limited in what you can say and time that you can say it, when it comes to things like, non-public information and whatnot. But certainly, when it comes to, hey, we're thinking about launching a new product as well, maybe it's a complementary fund to what you already have. Is this a fit? Are there other relationships that maybe we should try? Do you know of any other clients that have tried this or are thinking of trying this, and maybe we should go ahead on it? But kind of going back to before the product launch, we've actually worked with US Bank for years. Back in my Pure Funds days, we were one of their first clients on the fund side, and working with them, and maybe some other providers provide something similar, but we were doing at least a weekly call every single week leading up to launch, where we would have all the different service providers on these calls, making sure everyone had everything in place before you launched. And setting everything up for success before you launch is beyond just having your market makers lined up and your exchanges lined up. There are so many different service providers, and making sure that you have a team that understands that entire ecosystem. US Bank for us is the company that that schedules those meetings, make sure everyone's on the calls, has their agendas in line, and make sure that there's any open items that those get completed as well. So I just going back to before launch, that's actually for us a really important part of the process. I know my partner Bob Tull has a checklist of about 1,500 things that you need to have in place before you launch an ETF. And anytime he does a fund with us or helps a consulting client, these are all things that you go through. And so it's beyond even just finding your service providers, but if you have new things that you want to get out there, you're working with your PR firm, you're writing press releases, you might want to make sure that the exchange has that, so they're aware of things like that too. So there's many different ways that you can work with. I would suggest from someone in my position is don't be shy to ask. The worst they could say is no, or we can't we can't give you this answer. But if you don't ask, you don't get it. And in many cases, these are your partners, and they're here to try to help you to see you succeed.
Wow, I wish I had more questions for you, because that was a fantastic plug for US Bank, so I'm really happy. But all kidding aside, our job as a service provider is to be a free consultant. Like, obviously we have our fees for your product when it's live, but in that pre-launch process, we want to be there to give you that information and tell you the questions that you should be asking to these partners in order to get your product live.
Can I comment on the post-launch? In the interest of best practices?
I don't think I could stop you, Chris. So back to you.
Well, you were going to ask anyway. But so Andrew's launched a product, and now he's out there. He's talking about his space ETF. He starts telling the story, and let's just say it's not trading a whole lot. There's not a lot of volume. It goes 37 days in a row with light volume every day for 37 days. And as a market maker, maybe it's not on our primary list of, I'm not staring at it all day long because, look, our technology nowadays is kind of makes it easy to set the parameters and let it run and only alert you when it breaks. So, our attention gets focused on other things. Andrew decides that he's going to be on CNBC and he's going to be talking to Bob Pisani and they're going to showcase the product and talk about it. And we know what time CNBC is. It would probably be a mistake for Andrew to not let people know they're going to be talking about his product for the first time on primetime television, right? The reason why is the market makers, if they're not expecting a whole lot of things to happen in a particular security because it just hasn't happened in a while, and then all of a sudden, out of nowhere, it's like bing, 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 it starts to lighten up, and it's all one-sided. Look, the prudent thing to do is to, dial back for a second, take a quick look at it, and make sure that all systems are normal, because that's an unexpected, item to happen. So preparation, you can't say too much. Non-public information can never be shared. But you are allowed to say, hey, we're going to be doing a marketing campaign on this product. It's going to start on this day. We're expecting to hit a lot of ears and a lot of people. We're going to be sending out 400,000 blast emails. And this is all new. So don't be surprised if you see an increase in activity in a particular name or a strategy or something like that. That's just best practices. Because we can't, your advisors and their clients may not know how to trade stocks and ETFs the way we know how to trade them. They might just be throwing stuff in there at the market, hoping for the best price, and we usually try to dial people back from stuff like that. You're shopping it's your investment as an advisor. You're shopping, for a product. You found the product you want. You don't just race in and throw the money down and just take whatever price is given. You put people into competition. And that's what's so great about the modern day ETF market making structure in the US markets. There's amazing competition. The top 5 or 6 market making firms are so incredibly tight and active and competitive on ETFs. I mean, the pricing's, it's like nothing you can ever imagine. So the products that don't trade a whole lot, put people in competition, make sure people know that you might be active or it could be busy so that they're not caught off guard, spreads don't widen out, liquidity doesn't dry up. You don't want that to happen because then you work so hard to get these clients and then they have a bad experience on the execution, they're going to leave you forever. So it's really important to get ahead of that, prevent them from making mistakes.
Nope, couldn't agree more. You're talking about best practice, and the question that gets asked to me more often than any other question I've been asked in the ETF space is, when someone's launching an ETF suite for the first time, how do you staff that new hire? And Allie, I'll hand this one to you to get your thoughts.
Yeah, I think especially for suites, especially with a lot of the new firms that we're seeing coming into the space, you can go about it now in so many different ways. There's all types of service providers like US Bank, other types of white label providers that can help you. I think having that some amount of capital markets or operational expertise in-house, even if it's just one person to start, kind of as you're getting that business off the ground, is so pivotal. I think you want, whether it's the market makers or advisors or other people, kind of to Andrew's point, you want to have that number or that person that they can call. And I think as from a people perspective, the more that you invest in the business kind of upfront, again, just with just one person to start, I really think it builds credibility, it builds your brand. So I do think the capital markets and operational expertise is crucial. The sales piece is a large part as well. People take different strategies in terms of, do you have generalists, do you have specialists? And I think there's kind of a lot of ways that you can take that as well. But again, especially for new firms, that operational piece is kind of paramount.
Chris, what are your thoughts on the topic?
No, Allie said it best. I think especially if you've got a bigger suite, and there are a lot of big legacy investment managers coming to market with suites of ETFs, it's important to put a capital markets person in place that just knows how to pivot. They don't have to be a portfolio manager. They don't have to be a lawyer. They don't have to be a market maker. They have to know the lawyers. They have to know the PMs. They have to know the strategies. They have to know how to reach US Bank. It's sort of... it's that triage person that knows if everything's going well, the capital markets person should have the easiest job in the world. that person's critically important when people need answers fast, and they're going to be looking in 5 or 6 different directions on any given day. So,
Yep. So we've talked a lot about the infrastructure and how this system is built and how we work together. So let's talk a little bit about why that matters. And Chris, back to you. God, I keep going back to you. Can you speak a little bit about the NAV return and the impact of trading and all the things we talked about today and how that impacts, the end state in the ETF?
yeah, again, back to basics. So many people are so familiar with mutual fund trading and getting net asset value all the time. The ultimate benchmark, I think, for ETFs is NAV or better, meaning if you're buying at a discount or if you're selling at a premium to NAV. I think that would be everyone's, best wish. It's not so easy for the average investor to calculate these things in real time, so I would say trust that the markets are efficient. There are costs associated with net asset value that the end investors should be aware of. You can't just come in and say, I want NAV, give me NAV. It's not free. It costs money to create shares of an ETF. There's always a fixed cost. There's oftentimes a variable fee that goes into that. The market makers themselves, when they go to build these portfolios, have execution costs of their own or borrow costs. Or then sometimes if they're selling on a redemption, they have SEC fees. For foreign securities, there's stamp taxes and other fees that come into play. So understand, the way I think, when you're thinking about a NAV target for an ETF, unlike a mutual fund, you should be thinking about it like this. If I were to try and do this on my own, and by the way, go to the issuer's website, pull down their daily holdings file for the ETF. Every ETF has a website with their holdings available for everyone to see, and say, you know what, I don't need a market maker. I don't even need this ETF. I'm going to do it myself. Figure out how much it's going to cost you to do it yourself, to go out and buy 300 names in 14 different countries at the same time, or maybe not at the same time, and figure out what your cost of execution would be. And then look at the ETF and figure out what a market maker is willing to sell it to you for versus net asset value. I'm willing to wager that market makers almost always are going to come in at a much better price than what you or I can do individually to put together these portfolios. That's just kind of the truth of the matter. But understand this. In 25 years, we collectively didn't raise $9 trillion by being inefficient. They're incredibly efficient products. The market makers have always made exceptional, risk markets and provided great, efficient liquidity. And it goes without saying, the last thing in the world you ever want to do is put the market makers out of business because you wanted everything for free. Because that'll last for about a day, and then we're all in a bad spot. Now we have no one to provide liquidity anymore. Now we have 3,500 products and no one to make a market in them. So you do want to ensure that arbitrage mechanism exists forever, because it keeps those market makers coming back every single day.
Yep. Now I'm going to go to either Ali or Andrew. I'll let either one of you choose, as long as it's not Chris. Can you give a little commentary on your thoughts on, does spread actually impact the ability to distribute the ETF?
I'll jump right in. I've seen it firsthand. As a market maker myself, back in the days, there was an issuer who I won't name that right now is a huge issuer of products, and one of their first ETFs to them seemingly was a flop, and they reached out telling me that unless they could start getting more activity and more AUM to this fund, they were going to shut down the shop, and the spreads were about $1 wide. It was the only fund in its in its peer group, and they couldn't figure out why no one was trading it and why the spreads were so wide. Well, I think it was about 150,000 or 200,000 share creation units, and because it didn't trade that much, no market maker was willing to get short and either get bought back in or create and now be long, almost 200,000 shares of something that was fairly illiquid and not trading. I notified them, hey, did you think about trying to reduce the size of your creation units? And they said, you can do that. Sure enough, they did. All of a sudden, volume came in, and now they are in the tens of billions of assets under management. Things like that, there are little tweaks and things like that where if you're not sure of what you're doing and you're just launching a product just because, hey, it's easy to do an ETF and there's potential way to make money, you're going to miss out on the bigger opportunity of being able to actually grow your funds properly. Being able to have tight spreads makes investors happy as well, so that when they come in, they know that hopefully they're getting close to NAV. When they get out, hopefully there's that liquidity there as well. And if you don't have tight spreads, although the market making community will tell you, there is this liquidity there. If you do put in large size, someone will show up to meet that other side of the equation. Sometimes smaller investors don't necessarily believe that, and that opinion could affect spread long term and the success of those funds. So ideally, you do have that liquidity, but if it's something where the underlying basket is fairly liquid itself, try to reach out if you have the capabilities to a market maker and see where they might quote you, on the other side of the trade, because it might be a lot better than what you actually see on the tape.
Yeah, I mean, we've talked a lot about the institutional nature and how all these firms work together. But on that topic, when you have actually created the product, it's being sold, the RA now holds it, what types of questions are you getting related to the actual NAV of the ETF versus the performance of the ETF, obviously driven by the bid-ask spread? So what types of questions are you getting from advisors, and how are you addressing some of them?
If the fund is illiquid, the price that you might see on the tape might not actually match NAV. If it's an illiquid fund, you might not be having many trades during the day. If you have most of your trades during the day, but a fund closes at a completely different price at 4 o'clock or after, where there hasn't been a trade recently, you might see a fairly large discrepancy there. For us, I think every now and then the confusion might be more so when there's either a premium or discount to NAV. Is all the funds that we have are global in nature. So when you have a global basket, just because the US is closed doesn't mean that other markets aren't open. Just because the US is open doesn't mean that other markets aren't closed. So the way that market makers try to determine where that fund might open up, the underlying securities might open up when Australia and Japan and Europe opens the next day, they have to put some type of proxy in place so that they could put on and take off their hedges properly. So just because something doesn't necessarily match up with NAV also isn't necessarily a reason for concern. It may just be because there hasn't been too much liquidity in the product. If the advisor is reaching out saying, hey, we are looking to do size, or we're looking to unfortunately exit the position, and they don't know who they can reach out to, there's certainly different resources that you can provide them with as far as who may be active in that security that they may want to have a conversation with.
Excellent. So I see Jim lurking in the background over there, which leads me to believe that we're towards the end of our time. So on behalf of US Bank, and then separately my esteemed panelists, we appreciate your time and happy to answer any questions you have. You'll see me out there, and thank you for your time.